Chapter 11 looked at some one-period decisions regarding accepting or rejecting special orders, making or buying a component, um, continuing or discontinuing a business segment. And in Chapter 11, we had a rather myopic view of our decisions. It was a one-period approach. In Chapter 12, we're going to examine capital budgeting decisions. And capital budgeting decisions are multi-period decisions. They essentially involve any decision that has an initial cash outlay today in order to obtain some sort of future benefit or return. Typical capital budgeting decisions might include cost reduction decisions. Should new equipment be purchased to reduce our cost or improve performance? Expansion decisions. Should a new plant or warehouse be purchased to increase our capacity and sales? Equipment selection decisions. Which of several available machines should be purchased? Lease or buy decisions. Should new equipment be leased or should it be purchased? Equipment replacement decisions. Should old equipment be replaced now or later? But the common thread in all of these decisions involves some initial cash outlay with an expected benefit to be accrued over a number of future periods. There are two main types of capital budgeting decisions. They can fall into screening decisions, and the second category is preference decisions. Screening decisions relate to whether a proposed project passes some preset hurdle. For example, our company might have a policy of accepting projects only if they promise a return of 20% on our initial investment. Whereas preference decisions relate to selecting among several competing courses of actions or investments. For example, a company might be considering several different machines to replace an existing machine on its assembly line. Do we pick machine A or do we pick machine B? In making a capital budgeting decision, essentially we want to compare a project's cost with its future benefits. If its cost is less than the benefits that it provides, then we want to accept the project. On the other hand, if the machine costs more than the future benefits that it provides, we want to reject the investment opportunity. And while it seems fairly straightforward, the biggest challenge is going to be in measuring those costs and benefits. In general, we're going to find measuring the cost is fairly straightforward because at the beginning of a project, we have an initial cash outlay for a piece of equipment or a new project. That's our cost. But measuring or quantifying the future benefits, that's going to be more of the challenge. There are a number of different ways to measure cost and benefits. In this chapter, we're going to examine the payback period, a simple rate of return, net present value, an internal rate of return, and a profitability index. The first two, the payback period and the simple rate of return, are rather unsophisticated means of evaluating or making capital budgeting decisions. The payback method simply refers to how long will it take us to recover our initial investment. It ignores the time value of money. The simple rate of return is an accounting-based measure, which is somewhat dependent upon some of the accounting choices we make, particularly with respect to depreciation. The final three decision-making criteria, the net present value, the internal rate of return, and our profitability index, are the key means for evaluating or making capital budgeting decisions, and those are going to be the primary focus of this chapter. These three methods recognize that there is a time value associated with money. That is, a dollar is worth more today than a dollar that we receive a year from now. Therefore, investments that promise earlier payoffs or return are preferable to investments that promise later returns. And again, the net present value, internal rate of return, and profitability index are capital budgeting techniques that best recognize the time value of money, and they involve discounting cash flows. You should take a few minutes and review Appendix 12A in your textbook and watch the lectures on performing time value of money calculations and discounting cash flows using present value tables and or your financial calculator. Time value of money techniques will be essential to calculate net present values and understand internal rates of returns and the profitability index. But again, at the end of the day, a capital budgeting decision is simply a decision that compares the costs of a project with its future benefits. And if the benefits are greater than the cost, we'll accept the project. But if the costs are greater than the benefits, we will reject the project. And again, we're going to focus now, the rest of the chapter, on how exactly we want to measure those costs and benefits.